Understanding candlestick patterns is one of the most vital components of trading profitably. However, you might be surprised to learn that a vast majority of traders still use them incorrectly. The most challenging aspect of trading these patterns is determining which ones truly yield results, especially since there are so many of them to learn. But here is the honest truth. 99% of these patterns do not actually work. I know this from personal experience because I have rigorously tested almost all of them throughout my trading career. Despite this, I have discovered a small handful of patterns that perform exceptionally well. To this day, these specific patterns have generated a significant amount of profit for me. In this video, I am going to reveal the top 6 candlestick patterns that are proven to be effective, and I will provide everything you need to know about them. As an added bonus, I will reveal how to integrate these patterns with price action to identify high probability trade entries. Furthermore, I have created a free guide that compiles all these high win rate patterns into a single document. Inside, I provide real trade examples along with tips and tricks to boost their success rate. You can use this as a reference whenever you are trading. If you want access to this guide, you can find it inside my free Telegram community. The link is located in the description. Now, let's get into the video. What are candlesticks? First, we must define what candlesticks actually are. Simply put, candlesticks are a visual method for viewing price history. Each individual candlestick represents the price movement of an asset over a specific period of time. For example, if you are viewing a 1-hour time frame, each candle represents 1 hour of price history. If you are on a daily time frame, each candle represents 1 full day. A common question beginners ask is, why shouldn't we just use line charts? Wouldn't that be simpler? The answer is that candlestick charts provide significantly more data about the market compared to a standard line chart. Let's look at an example using the EUR/USD pair. On the left we have a line chart, and on the right a candlestick chart. While they follow the same general shape, the line chart only reveals one piece of information, the closing price for each period. In contrast, the candlestick chart provides 4 distinct data points for that same period. The open, the price at the start of the period, the high, the highest price reached during that time, the low, the lowest price hit during the period, the close, the price at the end of the period. Why this information matters? To see this more clearly, imagine a line chart and a candlestick chart forming simultaneously. The line chart only tracks the close, while the candlestick chart reveals the battle that occurred during that time frame. As traders, this extra information gives us a much deeper understanding of market sentiment, allowing for more informed decisions. For instance, imagine the price hits a support level and bounces. A line chart only shows the bounce. However, a candlestick chart might show a long wick dipping below the support before closing back above it. Image comparing a line chart and a candlestick chart at a support level. This detail tells us that sellers tried to break the level but were rejected by buyers. These nuances are crucial for price action traders because they offer hints about where the market might head next. Anatomy of a candlestick. There are 2 primary types of candlesticks, green and red. A green candle forms when the price closes higher than it opened, indicating that buyers were more aggressive than sellers. A red candle forms when the price closes lower than it opened, showing that sellers held more power. Every candlestick consists of 2 parts, the body and the wick, also known as shadows. The tips of the upper and lower wicks represent the absolute highest and lowest prices reached during that period. The body is slightly different based on the color. Green candle. The bottom of the body is the open, the top is the close. Red candle. The top of the body is the open, the bottom is the close. Interpreting shapes. Body versus wick. On a chart you will notice candles come in various shapes. Some have massive bodies, others have tiny bodies with long wicks. Each shape tells a unique story. Big versus small bodies. A green candle with a large body demonstrates that buyers were dominant. Price opened low and was pushed significantly higher with very little resistance from sellers. Conversely, a red candle with a large body shows seller dominance. The price opened high and was driven down sharply. A candle with a small body indicates a lack of dominance. For example, a small green candle shows that while buyers were in control, sellers put up a strong fight, causing the price to end near where it started. Large wicks. The size of the wick is equally informative. A long wick on the bottom indicates strong buying pressure. This means the price dropped significantly at one point, but buyers were strong enough to push it all the way back up before the candle closed. A long wick on the top indicates the opposite, strong selling pressure. The price surged upward, but sellers rejected that move and forced the price back down. Small body with equal wicks. If a candle has a tiny body and equal wicks on both sides, it signals indecision. Neither buyers nor sellers were in control, and the market is essentially in a stalemate. Pattern number 1, the engulfing pattern. The first of my top 6 patterns is the engulfing pattern. This is a 2-candle setup consisting of a smaller first candle followed by a much larger candle of the opposite color. The key requirement is that the body of the second candle must completely engulf or cover the body of the first candle. Bullish engulfing. A small red candle followed by a large green candle. This often signals an upward reversal. Bearish engulfing. A small green candle followed by a large red candle. This often signals a downward reversal. If price is in a downtrend and a bullish engulfing pattern forms, it indicates that buyers have suddenly become much stronger. Generally, the larger the second candle is, the higher the chance of a successful reversal. To trade this, you can enter a buy position at the close of the large green candle, with a stop loss set at the bottom of its wick. The same logic applies to the bearish version for sell positions. Pattern number 2, the pin bar. The pin bar is a single candle pattern characterized by a very small body and a disproportionately large wick on one side. Bullish pin bar, a small body at the top with a long lower wick. Bearish pin bar, a small body at the bottom with a long upper wick. A bullish pin bar tells us that sellers initially drove the price down, but buyers stepped in with massive force to reject that move. While some traders enter immediately, I prefer to wait for a confirmation candle, another candle in the same direction, before entering. Once confirmed, you can enter after the close and place your stop loss at the end of the pin bar's wick. Pattern number 3, 3-bar continuation. This is a 3-candle sequence used to identify a trend that is likely to keep moving. Candle 1, a large body, bigger than the average candle. Candle 2, a small opposite-colored candle, ideally less than half the size of the first candle. Candle 3, another large candle in the original direction that closes beyond the second candle. In an uptrend, this pattern suggests the price will continue to rise. It's a great way to enter if you missed the initial move. You can place your stop loss at the bottom of the second, middle candle. Pattern number 4, 3-bar reversal. This pattern is also a 3-candle sequence, but it signals a change in direction. Candle 1, a large full-bodied candle. Candle 2, a smaller candle of the same color. Candle 3, a large full-bodied candle of the opposite color. The success rate is higher if the third candle's body is equal to or larger than the first candle. If you see a bullish 3-bar reversal during a downtrend, it signals an upward move. You can enter at the close of the third candle and place your stop loss at the low of the second candle. Pattern number 5, breakout candles. This pattern consists of a series of small consolidation candles followed by one massive breakout candle. It shows that the price was stagnant or trapped in a range until one side finally exerted enough pressure to force a sharp move. For a valid setup, you need at least 3 small consolidation candles. The more consolidation candles there are, the more powerful the eventual breakout tends to be. In a bullish breakout, you enter at the close of the large green candle and set your stop loss at the opening price of that same breakout candle. Pattern number 6, shrinking candles. This pattern involves at least 3 consecutive candles of the same color that get progressively smaller, followed by a large candle of the opposite color. This visual sequence suggests that the current trend is losing momentum, the shrinking candles, before a sudden reversal occurs, the large opposite candle. I recommend looking for the 4th candle to close beyond the second candle for better confirmation. For a bullish reversal, you enter at the close of the green candle and place your stop loss below the previous candle's low. The advanced price action strategy. While these patterns are strong, they are most effective when combined with key levels on higher time frames, 1 hour or higher. Patterns on lower time frames are often less reliable due to noise. Step 1. Identify key levels. Look for support and resistance zones or trend lines. For example, if price has reversed twice at a specific level, mark that as support. Step 2. Wait for interaction. Wait for the price to return to that level for a 3rd time. At this point, we expect a bounce, but we don't just guess. Step 3. Seek confirmation. Look for one of our 6 candlestick patterns to form exactly at that key level. If a bullish 3-bar reversal forms right at a support zone, it provides a high confidence entry signal. Example, trading at confluence. Let's look at a confluence level, a point where multiple key levels intersect. such as a horizontal resistance level meeting a descending trend line. These areas are highly likely to cause a price reversal. If the price reaches this confluence and forms a shrinking candle pattern, it confirms that buying pressure is fading exactly where we expected resistance. This provides a perfect short entry. You can place your stop loss above the high of the previous candle and target a 2-to-1 reward to risk ratio. Final resources. If you have stayed through this entire tutorial, it shows you are serious about your trading education. To help you further, I've compiled all these high win rate patterns and 3 additional strategies I didn't have time to cover here into a free PDF guide. You can grab this guide in my free Telegram community, linked in the description. Simply go to the Files section. You'll also get my regular market analysis for Forex and crypto. I look forward to seeing you there and helping you level up your skills. See you in the next one.